In this video, let's talk about what happens to dividends during a recession. And I'll give you an update on my US dividend growth investing portfolio and the newest addition into my portfolio as well. And it's gonna be pretty jam-packed today, so if you enjoy this video at any point, just make sure that you gently smash that like button, and that will mean the world to me. And without further ado, let's go! Now let's start the video off with a portfolio update. In the month of May, I've added another 1,500 Australian dollars into the portfolio, and my newest addition in my US dividend growth investing portfolio is BlackRock Inc. Don't worry, towards the end of the video, I'll explain why I want to own BlackRock for the next 20 to 30 years. Now, what you see in front of you right now is the most up-to-date screenshot of my US dividend growth investing portfolio. One of the main points I wanted to make here is that please ignore the total returns. A couple of days ago, before I took the screenshot, it was actually negative and it was red. Majority of the portfolio was actually red. So the markets are really volatile at the moment. And the point I'm trying to make here is that I'm not overly concerned with the total returns right now, because the most important thing to me as a dividend growth investor is that my dividends is growing month on month. Because if my dividends is growing month on month, I know that my income stream is growing month on month. Now, as I invested more in both my US and also Australian dividend growth investing portfolio, you can see here that even though there's a small decline or stagnant position in March and April, we're really starting to go up in May again. Now, in the month of May, the month is not over yet, and I've only received 7 cents of actual dividends from Apple this month. So we'll see towards the end of the month whether I will get any more dividends, but my expected monthly dividends is somewhere around $250, which I'm pretty happy. It will keep me motivated over the long term. And on the point of Dropbox and GoPro, these are actually free stocks that I got from some of you using my link to sign up to stake. So yes, if you want a free stock of either Nike, GoPro, or Dropbox when you fund your account with stake, use my link in the description below. If you have any questions around my dividend portfolio or just questions in general that you want to ask me, just let me know in the comments below. Maybe I will include some of the questions for some of my next videos as well. Now, before we jump into what happens to dividends during a recession, I wanted to make sure that we're on the same page when it comes to our understanding of what a recession is. Now, there is the textbook definition of what a recession is, which is essentially 2 consecutive quarters of negative GDP growth. And that's when we're officially in a recession territory. Now, you also have the National Bureau of Economic Research definition, and they define a definition as a significant decline in economic activity spread across the economy, lasting more than a few months. Now, you can read the rest yourself, but for me, the keywords there is significant decline in economic activity and lasting more than a few months. Now, between the two versions of definition, I think the National Bureau of Economic Research has a little bit more of a subjective view and a more loosely defined timing of a recession. But for me, I tend to understand recessions from a point of key characteristics. So with some of the key characteristics of a recession, there's usually a very high unemployment rate. Now, with a high unemployment rate, risky assets like equities or shares, depending on what industry those equities are in, tend to lose value. As more people are unemployed, they don't tend to spend as much, and therefore the earning expectations come down naturally. And as their earning expectations come down, the assets tend to lose value. Now, before we move on, I wanted to build on the concept of recession just a little bit more, because bear markets and recessions tend to be thrown together in a single sentence, and I know that it becomes very confusing at times because what is the difference between the two? Now, with bear markets, it's usually a sharp drop of 20% in value from recent heights. Now, you can see here, this is an example of a bear market. Now, it recovers pretty quickly. It doesn't last very long. However, on the other hand, on recessions, now as you can see here, this is after World War II. We had a very tough time here. And same with the dot-com bubble and also GFC. The easiest way for me to understand the difference between a bear market and a recession is that bear market is a sharp drop of 20% or more, which only lasts for a few months. Whereas recessions is basically a sharp drop, but over a longer period of time. Okay, so now that we have a more common understanding of what a recession is, the next logical question becomes what happens to dividends during a recession. Now, over the last couple of videos, I've shown this graph a few times, and I think this graph is a really good starting point to understand what happens to dividends during an economic downturn. Now, during the negative years for S&P 500, dividend aristocrats have generally outperformed the market, with the exception of first quarter 2020. And to me, I think the main reason for this is that the public health crisis we are experiencing right now requires more help from remote work access and also a heavier reliance on e-commerce, which both areas are significantly underweighted in dividend aristocrats. But in order to better understand the impact of recessions to dividends, we need to stretch out the timeline and look at dividends only. Now, since World War II ended, there has been 11 recessions and bear markets. And bear in mind that because I am a dividend growth investor, the share price to me is less important than my dividends growing. So first things first, let me address some of the outliers. Now, for the outliers, this is right after when World War II ended. And this period was the post-war boom, and dividend payouts were essentially signs of higher corporate profits. And for 08 and 09, when the Federal Reserve bailed out majority of the banks, part of the condition was you can't use the bailout money for dividends. So it's understandable when it comes to a massive dividend cut here, and also a massive boost here as well. But in any other time, it's hard to say whether there is a trend or not. But generally speaking, if we take the outliers out of the equation, on average, during downturns, dividends were cut 1.9%, whereas share price were cut almost 30%, more than 30%, that is. Now, the problem with averages is that it eliminates the context of the recession, which may or may not impact dividends at all. But knowing that over the last 60 odd years, that in an economic downturn, dividends were only cut by almost 2% instead of being cut 30%, I can at least sleep at night and get on with my life. Okay, so now that we're established that during recessions, dividends tend to be less impacted, the next logical question becomes, how do we work through a recession? Now, for me, if we head into a recession territory, this will be the first recession I am consciously aware of what's happening around me. Now, the last time something this severe has happened during 08 and 09, I wasn't really consciously aware of what's happening around me
because I was still in high school at the time.
So over the last couple of months, I've spent a lot of time thinking about how I could potentially work through this recession, whether it's gonna last weeks, months, or years. So here's the plan. So here's my plan to work through the recession. The first step is I'm going to continue saving 50 to 60% of my monthly paycheck. The only difference is that instead of investing majority of that money, I would add a little bit more cash to my emergency fund. That's just because I have no idea what's going to happen in the future. I want to give myself some breathing room just in case something happens. Now, the second step that's really important to me is that I need to find ways to earn more. Now, if you just started following me, I'm a growth marketer by trade. Now, what that really means is that I help companies grow by Facebook ads, Google ads, or search engine optimization. I make majority of my income here, and I can either earn more by basically finding more clients, or I could diversify my income stream by building up my YouTube channel, my blogs, and a few of the other things. If you're interested to know how and what I've done to diversify my income stream, I actually documented my entire strategy in my Side Hustle Ideas 2020 video, which I'll leave in the description below. Now, the third thing is, because of what's happening in the world right now, some of these asset prices in the stock market is going to be once or twice in my lifetime. If I'm lucky, it'll be 3 times, but it's important that I find ways to invest as much as I possibly can. But the most important thing is that if I were to invest, then I need to do heavier due diligence on the companies I want to invest in, because I want to own them for the next 20 to 30 years. So it's really important that I invest in companies with strong fundamentals and economic moats. Now, one of the more common questions I got asked recently is, should you sell during a recession? The diplomatic answer is, it depends. Now, it depends on your time horizon, it depends on your risk tolerance. I can't really speak for yourself because you understand yourself the best. But for me personally, I really don't sell that often. I will only sell if the company cuts dividends or their economic moat have eroded to the point that it makes no sense to keep them anymore. Of course, there are exceptions if the company is cutting dividends because they needed the money for acquisitions to grow during this period or even to survive during this period. So I tend to assess this more on a case-by-case basis. But honestly, if you have done your due diligence right and you plan to own these stocks for the next 20 or 30 years, I don't plan to trade them. And therefore, I don't really sell often at all. Now, if you want to know what my process of selecting individual dividend growth stock is, I actually talked about this very extensively in how many stocks you should own in your portfolio. Now, I'll leave a link in the description below if that's something that you're interested in. But honestly, I really don't sell that often because I tend to do a lot of research on these stocks, and I always bear in mind that if I'm going to invest in this stock, I plan to invest in them for the next 20 to 30 years. Now, I'm really excited that I've added BlackRock to my portfolio. And let me share with you why I think I'm going to have BlackRock in my portfolio for the next 20 to 30 years. Let's start off with some of the qualitative reasons on why I decided to invest in BlackRock. BlackRock is the world's largest asset manager with over 7.3 trillion US dollars under management. The second largest is Vanguard, and they have $6.2 trillion. The difference between BlackRock and Vanguard is 1.1 trillion. The second point is that the CEO, Larry Fink, co-founded BlackRock in 1988 and still the CEO 32 years later. There are only a handful of CEOs in the world with that kind of tenure, and Warren Buffett is leading the charge with a 50-year tenure as a CEO at Berkshire Hathaway. And the last point is more of a recent development. In early April, the Federal Reserve announced 3 programs to buy corporate bond ETFs for the first time ever, and with all 3 programs overseen by BlackRock. Now, the amount of money that they make from this deal will be modest, is nothing exorbitant, but the brand equity as an economic moat will be so wide that it's basically borderline impossible for any other business to replicate. This is actually the second time that the Federal Reserve turned to BlackRock for help. The first time was during the global financial crisis when the Federal Reserve asked BlackRock to help finance the $30 billion deal on the sale of Bear Stearns to JP Morgan, the $180 billion bailout of AIG, the $45 billion for Citigroup, and on and on. This is actually the second time Federal Reserve have asked for help. Again, what I'm most interested in is their brand equity that's going to be built based on their track record of the Federal Reserve, which is essentially the government asking for help from BlackRock. Now, whether they do a good job or not when it comes to the government's debt buying efforts, we'll have to wait to see. But I really don't think any company can replicate this kind of economic moat over the next 10 to 20 years. I mean, that's a really wild claim, we'll see, but I just think it's highly unlikely that someone else could replicate this kind of brand equity. Okay, so let's look at the numbers and see what's under the hood. Now, over the last 5 years, BlackRock have grown 8.5%, and that's a very reasonable number because normally I tend to look for companies with earnings growth anywhere between 5 to 15%, because the principle here is that dividends are paid out of earnings, and if the earnings aren't growing, it just means that the dividends is not going to be sustainable over the long term. So let's dig a little deeper into their balance sheet. Now, the most recent snapshot that I could get is on the 31st of March 2020, and it seems like for every 18 cents of debt, there is $1 of equity. And so far, so good. It's very likely that BlackRock will have no problem weathering the storm over the next couple of years. In terms of dividend growth, since 2004, you can see that there's a very steady trend upwards in terms of their dividend payouts. They have never really cut the dividends. If anything, during 08 and 09, the dividends have stayed exactly the same. And since then, it's just been growing. And because of both those qualitative factors and the quantitative factors, this is one of the reasons why I plan to own BlackRock for the next 20 to 30 years. And that's it for this week's video. Now, next week, I'll give you a mini office tour in terms of what gear I have, what's in my bookshelf, just let you into my studio just a little bit so that you can see behind the scenes how I'm creating these videos for you guys. Now, as usual, if you enjoyed this video, make sure you gently destroy that like button because that helps out my channel out a lot. And also remember to subscribe, click onto the bell so that you'll be the first one to know when I release brand new videos every week. And as usual, he's actually right here. And until next time, he's gonna do the honors and say